Good morning, everyone. My name is Connie and I'm the Director of NZ International Tax and Property Advisors. Welcome to the final webinar, Strategies to Combat Interest Limitation on Commercial Investment. We've got lots of exciting materials, so stay tuned. Feel free to post your queries during the webinar and we'll endeavour to answer all queries at the end of the webinar. We're stoked to have Alistair and Bibiana and Blandon again. So Alistair is the Director of Macrae Property Brokers. Bibiana is the partner of the Leung law firm, and Blandon, the director of MHQ Mortgage Advisors, to talk to us about commercial investments today. First up, I'll talk about the new interest limitation rule and the commercial property exemption and other tax advantages for commercial property investment over residential property investment. Then we have Alistair to talk about what to look for in a good commercial property. Then we have Bibiana who goes through property law and regulations for commercial property. And lastly, we have Blandon to talk about financing for commercial property and how to leverage equity in your existing property portfolio. So I'll start with the new interest limitation rule, the inclusion and exclusion, other tax advantages for commercial properties, investment, available ownership structure to buy commercial properties, and the pros and cons of different ownership structure. And lastly, I'll finish off with a case study. Before I dive further, I'd like to share how I crossed paths with the property industry. So I grew up in a household where my family talked about issues they're having with their commercial and residential property investments. Their property investments were in residential and commercial, and I gained experience from helping my family with managing their property portfolio. And again, this is repeating to those who haven't actually attended our previous two webinars, just a brief introduction of myself. So I kind of did that after graduating from University of Auckland with a Bachelor of Commerce, conjoined with Bachelor of Property and Master of Taxation Studies degree. And over the last 10 years, I observed how issues were addressed and how risks were minimized, and gained a wealth of commercial and residential property consulting experience while working as a full-time tax accountant. I started investing in both commercial and residential property in my mid-20s after graduating and saved funds for a deposit after working for a few years. So a bit about my background. So while investing in both residential and commercial properties, I worked as a full-time tax consultant at a big four mid-tier chartered accountant firms. I've lectured tax at University in Auckland and helped my family with their residential and commercial property investments. I'm a chartered accountant and I started my own firm last year. So we're a one-stop chartered accountant firm specializing in property tax and consulting, cross-border tax for migrants, ID disputes and resolution, and SME tax. Our clients are property developers, property investors, SMEs, expats, and migrants. Just thought it's quite useful to summarize what's included and excluded from the new interest limitation rule as a start. So the new interest limitation rule only applies to the residential short and long-term accommodation and doesn't include commercial property. So interest on that is incurred in holding commercial property are still deductible. And another few interesting exclusion that is that includes land outside New Zealand, and we've covered new builds and residential property development in the past webinars. And other exclusions include employee accommodation, farmland, care facility, commercial accommodation, retirement villages, and rest home and business premises. Here are some other tax advantages for investing in commercial property. So we've talked about how interest continued to be deductible. Whereas for residential, if you've got existing property, if you had hold the property before the end of March this year, then you would have that phase out, that grandparented interest deduction, and that's phased out over 4 years, which we talked about in a new bill webinar. So I won't repeat that in more detail. And if you purchase a property after an end of March, then it will not be deductible from the 1st of October. And then you've got the depreciation on building that is still is now reintroduced. which I'll talk further in the next few slides. So that's depreciation on building for commercial. It is still deductible now, but for residential, that's not. Because the depreciation rate on residential is 0%. There's no Brightline tier, so if you buy and sell in a commercial property, it might not be, so it's not subject to that Brightline tiers, but then we also need to consider whether other land taxing provision applies. But then we know that for the residential, there is that Brightline test there. And with the residential land withholding tax, it doesn't apply to commercial, and because the residential land withholding tax is linked with the Brightline test. Again, I'll go into in further details in the next few slides. Again, this is just still a summary. And also there's no ring fencing of tax losses for commercial properties investments, whereas there for losses, whereas residential there is. And in terms of claiming GST on expenses, you can register for GST and claim GST on expenses if you hold a commercial property, whereas for residential you can't, because providing residential accommodation for long term, it is a GST exempt supply. But if you are providing a short term accommodation, residential accommodation, like Airbnb, that can potentially be a GST taxable supply, and therefore you may have to register for GST. So the GST treatment for long term and short term residential accommodations are different. Okay, so starting off with the depreciation for commercial property. So almost 10 years ago, the depreciation rate on commercial building was reduced to 0%. So this has been reintroduced as part of the COVID relief package and was effective from the 1st of April 2020. Depreciation is calculated based on the cost of the building, and the cost consists of the purchase price and any capital improvements made up to the 1st of April 2020. So say landlords should ensure like all the non-deductible capital expenditure are captured in the cost base to maximize the depreciation deduction. So this might include seismic strengthening work or improvement work for commercial buildings. As an example, say if you have a commercial property with a 600,000 cost base, this can result in around 12,000 of non-cash tax deductions, because you go 60,000 times say 2% diminishing value, that will be around 12,000 non-cash deduction. And the resulting tax saving is around $3,000 to $4,000 per year, depending on the taxpayer's tax rate. So whether you're having whether the property is owned by a company, which is at 28%, or a trust, which could be at 33%, or in your personal name, again, depending on what sort of level of income you're receiving for that year. As I mentioned, the Brightline test is linked with the residential land withholding tax. So residential land withholding tax applies where disposal of residential land located in New Zealand, and that is taxable income under the Brightline test, and the vendor is an offshore residential land withholding tax person. As Brightline test doesn't apply to commercial property, residential land withholding tax should not apply. So this means that if an offshore vendor do not need to withhold tax on the sale of the commercial property if they buy and sell within that Brightline test period, and now it is 10 years with the recent changes. Next, we've got ring fencing of tax losses, which came into effect from the 1st of April 2019. The effect of these, the ring fencing of tax losses rule is that the losses incurred from the residential rental property cannot offset against other types of income, such as salary or business income, but is carried forward to future income years to offset against future taxable rental income or any proceeds from taxable land sale. Again, these rules doesn't apply to commercial property. What this means is that tax losses incurred from commercial property can offset against other income like salary and potentially future PAYE tax refund. Moving on to GST, landlords needs to consider the level of the commercial rental he or she receives or likely to receive to determine whether he or she is required to register GST for the entity that owns the commercial property. So if over 60,000 of commercial rental has been received in any 12-month period, then the commercial landlord needs to register for GST. If it's under 60,000 commercial rental, then the commercial landlord are not required to register for GST, but they can voluntarily do so if they wish to. And some tax benefit for registering for GST is potential zero rating on land transaction and the claim of the GST on expenses. Well, of course, the GST on commercial rental needs to be returned as well to the IRD. So here are various ownership structure that can own commercial property. So to determine which is most appropriate for the taxpayer, it is case by case, and the taxpayers' long-term and short-term personal and business goals should be considered. Also, the cost-benefit should also be weighed up to see if setting up that structure is worthwhile. So, say if the cost of setting it up and the ongoing compliance cost outweighs the benefit, then maybe there's no point setting up the structure and just having it in your personal name, being more simpler and more cost effective. So there are pros and cons to each of these structure. So for personal, the benefit is that there's less compliance and administration because you only need to file an income tax return, so IR3, and there's no setup cost at the upfront. However, asset and property is not well protected as compared to, say, a trust. In terms of look-through company, it is taxed at the marginal tax rate instead of the flat 28% tax rate. So if you've got income that is lower than, say, 70,000, the average effective tax rate would be lower than the 28%. And that's why I put it as a benefit. The look-through company still has a limited liability protection. And so that's another benefit of the look-through company. With the cons there would be the additional compliance with the having to prepare financial statement and prepare tax return for a separate entity within the look-through company, and also set up costs. And then an election also needs to be made to the IRD to elect the ordinary company to become a look-through company. And in terms of the ordinary company, the benefit here is that the tax rate is 28%, so it may be better for higher income earners, because currently the highest personal tax rate is at 39%, right? So there's already that tax savings there with the differential. And again, limited liability protection for ordinary company. And the cons is that you can't really distribute capital gains until the ordinary company is wound up, because during the existence of a company, any transfer of value from the company to the shareholder, it's likely to be treated as a dividend, and that is taxable. So unless you wound up, and in order to get if you've got any capital gains in that ordinary company and trying to get it out, winding up is one of the options there. There's the trust, and the benefit of having a trust, there's a few here. We've got asset protection, estate planning, share of the trust income with beneficiary, and distributing capital gains tax-free without having to wound up. And the cons here is that there is additional compliance, especially with the recent change in trust law at the beginning of this year. There's additional compliance and disclosure, so that could add to the cost. So if you wish to explore this option, you can speak to Bibiana, who can help and its experience in this area. Just wanted to, I think, end up with a finish off with a case study. So we've got, say, Mr. Brown, who owns 14 residential houses and started to diversify his portfolio with buying commercial property. In the past 2 years, he purchased 4 commercial industrial property, and he's contemplating selling more to invest in commercial. So what we will look at is, okay, from the tax point of view, these would be some pre-acquisition considerations. So has he got the right ownership structure? So we've got the trust, look-through company, ordinary company that we can consider. So we need to consider Mr. Brown's short and long-term personal business goals. Say, for instance, if Mr. Brown has children who are older than 16 years old, having a trust would allow the flexibility to share the income with the children's at Mr. Brown's discretion every year. So that would reduce the overall tax liability. And Mr. Brown may also wish to create a separate entity for residential properties and commercial property due to the difference in the risk level. Commercial property tend to have a higher risk because of you're dealing with commercial tenants. However, having 2 entities does come with additional compliance costs. So again, going back to the cost-benefit analysis, is it worthwhile having that a separate entity for the commercial properties? Some other tax consideration during the holding period would be that we can continue to depreciate commercial properties on the 4 commercial property that he holds, but not for the 14 residential properties. Any commercial rental tax losses can offset against Mr. Brown's salary if he has any, which may result in a tax refund. And also leasing out a commercial property is a GST taxable activity. So Mr. Brown can claim GST input tax credit on the purchases, such as leasing commissions and marketing costs. If you wish to consider transitioning from residential to commercial property investment, you can speak to Alistair, who can help with finding good commercial property stock for you, and Blandon, who can advise how to leverage the equity in the residential property portfolio and to buy commercial properties. Some tax considerations upon sale is that commercial properties are not subject to the Brightline test. So if Mr. Brown decides to sell one of the 4 commercial property in, say, 2 years' time, it may not be taxable, whereas proceeds from the sale of the residential property is still taxable if it's purchased and sold within 10 years now. And for residential land withholding tax, it doesn't apply to the sale of commercial property, whereas it may apply to residential property because of the Brightline test if it applies. So here are some services we can assist with. We offer a free 15-minute consultation for new clients. We provide property tax compliance and consulting. We specialize in the area of cross-border property tax. We can also provide written and verbal tax advice. If you'd like to know more about us, you can go on our website, nztaxprop.co.nz. Before I pass you on to the next speaker, I will just share a gift for those who did not attend our previous webinar. So helpful guide for your next property purchase. As mentioned, feel free to post your queries in the chat box and I'll respond at the end of the webinar. If you wish to contact me, you've got my contact details on the slide. I'll hand you over to Alistair, who will talk about what to look for in a good commercial property. Over to you, Alistair. Thank you.